Thank you. It's a pleasure to be here. And this is actually really exciting for me because, as an M&A attorney, I don't actually get to see behind the curtain so much. It's oftentimes we're brought into the process. The deal strategy has been developed. It's conveyed to us, and we go about our business and use our legal tools to get the deal done. But here we're going to talk really more about developing the strategy. How does it tie into the general business plan? How do you develop your acquisition targets? What are you looking for with specific targets, and how do you develop your team? So this is for me, it's going to be an educational experience as well as just an opportunity to really see more of the process that leads up to the ultimate goal as on the legal side, which is getting the deal through and getting it done and hopefully having it be a success. So with that, I'll start at a pretty high level and just ask, what are we doing here? Why engage in M&A? What are the priorities? What are the reasons that we're doing what we're doing? And happy to maybe, Peter, start with you and go down the line because $35 billion in deals in the last 10 years. There's got to be a reason.
Thanks, John. So more often, when pursuing something in corporate development, an acquisition, a joint venture, a minority investment, it is a superior alternative to what else is available to the business to execute on its chosen strategy. And we always ask, what are we trying to achieve from a strategy point of view? What are the alternatives available to us? How do they compare? And is plan B close or far away? And that will motivate the team one way or the other relative to pursuing an acquisition.
Mm-hmm. Frank?
Yeah, I mean, to me, it's saying what you said. It's a means to achieve a strategy, and you can do the strategy either organically or you can do it through acquisitions. Let me give you an example. A couple of years ago, at our company, we decided that hard disk drives, which are in a laptop, is a business we would like to get deeper into. But all the customers, Western Digital, Seagate and so forth, they were in Thailand, and we had nothing in Thailand. Now, since we want to go deeper in this business, if we didn't have a presence in Thailand, we would be out sooner or later because you cannot just export. They would find somebody local. So the question is, do we do it organically by hiring people, a sales force, opening a factory, which would take some time, or do we try to acquire something? So we ended up acquiring 2 companies. So it's a means to achieve a strategy. And it's typically faster, might be more expensive, but it's typically a faster way to get into a market.
John?
Yeah, me? Yeah, no, I agree with both of those points. And one thing I would add from our standpoint, so I'm in the transportation logistics space, and we don't own any assets, we don't own any trucks, all we have is technology and people. And so finding those good people in a very fragmented market, we tend to hire very well right out of college, but finding good seasoned people from a pure hiring standpoint is very, very difficult for us. So one of the things that we look at from an acquisition strategy are there small family offices out there where you have a really successful guy who's built a business that may be, $20, $30, $40 million of revenue, and if we're able to bring that guy in and give him better tools, they can be much more successful on our platform. So when you look at, how do you grow in your speed to market, as you commented, it's difficult for us to kind of raise people up from the very bottom and get them to that execution level versus being able to buy these people. You get a book of business to come with it, but also you have some very high caliber people that can continue to grow with our firm.
Mm-hmm. So Peter, you mentioned it's a means to an end. It's a means to executing your strategy. Well, so in a Fortune 15 corporation where you've got diverse lines of business, how do you set that strategy? Where does it derive from? Is it top down? Is it bottom up? How do you when you have diverse interests within such a large corporation, how do you develop that?
That's a great question. I wish I knew the answer. No, I'm just kidding. For those who don't know, Cargill is $110 billion in sales, 153 years old, 155,000 employees, more than 75 businesses, operations in 70 countries, sales to 200 countries. It's a very big, complex place. So strategy is owned by the business, at whatever level that may be. And it aggregates to groups of like businesses, and then, of course, across the company. Excuse me. And so most of it is bottoms up, albeit there is a real important element of integration and collaboration and connectivity across the organization. Mm-hmm. And so it's best when those strategies and that homework are done by the business team. They develop that deep knowledge of their particular space, of what the alternative approaches may be, and they have a chosen winning strategy, and they have confidence and conviction around that.
John, how about you from your perspective?
Yeah, if you look at kind of structure and history, we're sort of the polar opposite. So Echo Global Logistics is my company. This is our 13th year in operation. And so we've grown from doing a few $1 million to, in revenue, our guidance this year, the high end's like $2.3 billion. So we've seen a lot of growth, but we're not very structured in terms of kind of where that comes from and where our who's making those decisions, just because we're growing so fast. We have a great management team that, I work with them in terms of, where we should go, what markets we should enter, what geographies we should enter, where we could continue to sell the products the services that we sell. But it's beyond reactive. It's not a reactive strategy, but we're not at a point where we have different business units and different kind of, individual on-the-ground people that can drive a bottoms-up strategy. We're more looking at it from, okay, we've enjoyed this success, where can we go next, and how can we do that?
Frank, you have thoughts on that?
Yeah, I have maybe a little bit different view, right? I agree with you that the strategy, especially in a company that size, has to be driven in the businesses, right? But before you do this, I think top management has to decide what businesses are we in, what business are we not in, which business do we really want to grow, and which ones maybe we just coast along, use as a cash cow, and so forth. And within this framework, within those borders, I think then the business units can go and find acquisitions. But you have to set the overall strategy, right? Because otherwise, you might have a business unit which you really don't want to get bigger into, and they might be just going gangbusters on acquisitions because they may be capable people. In the end, you end up with something you don't want to. So you have to set an overall strategy. And so what worked for us is we started with, when I took over as CEO, we said, who are we and what do we do? And so we are a little bit like a smaller version of 3M. So we make labels, signs, badges for people, right? And so we said, we identify and we protect premises, products, and people. So let me bring this home. So we identify people with badges, like stuff like this, what I left at my seat, or wristbands when they go to hospital. We identify buildings, premises with signs, like exit signs. We identify products with labels, like Intel Inside on a laptop, right? So, and then you have to make sure that everybody in the organization understands this. We identify premises, products, and people. And Jack Welch said once, if you want to make sure that everybody understands, you have to repeat it till you gag. So you have to repeat it over and over and over again till people get it. So who are we? We identify premises, products, and people. Second, what do we want to be? Well, we want to be number one or number two. So, and if you repeat this, and everybody in the organization understands this, every business unit, right, they can go after it. So that's how we did it. They could go after it, and never ever would they come up with something what wouldn't fit. Initially they did, and then we kind of, said that doesn't identify premises, products, and people. For instance, Italian pizzeria. Nobody would have come with an idea of buying an Italian pizzeria chain. Why? Because we would ask, does this identify premises, products, and people? And it doesn't, right? So I think it's very important that the whole organization, before you launch into a major acquisition spree, understands who are you, what business are we in, what do we want to grow, and where do we want to go.
If I might just add, I think that's a great answer. I fully agree. It is, in our experience, and. That corporate strategy is informed by all of the learning and the challenge and the opportunity that comes from the businesses. But it needs sorting and prioritization and it needs overall direction that leverages one part of the organization to the other, and that comes from the corporate.
When we started, I took one of my business leaders who was a general manager and said, you run acquisitions. So he would go to the business unit general manager and would say, so what do you want me to look at? He said, why don't you just bring me a couple of ideas and I tell you if I like it or not, right? And he said, well, that's not how it's going to work, right? Because if you do this, I'm going to come with so many ideas and you say, I don't like this, I don't like that. So you have to first agree on a framework.
Right.
You appreciate it, right?
Absolutely.
You know, you wouldn't want to go everywhere.
Yeah.
So, I mean, maybe this is one to open up the floor to with some experiences. I mean, we're talking about developing an integrated buy-side strategy, and obviously, you know, if you're a smaller organization, that having that focus on an integrated, objective and principled buy-side strategy is easier than when you have diverse interests. But I'm curious as to experiences in the room or views as to the success or limitations in either the top-down or the bottom-up approach, and any insights on that topic.
Thank you. I'm just curious, how heavily do you rely on third parties to help you source buy-side deal flow? Or do you source it all from your internal resources?
I'll take that. So I look at kind of, there's three different markets that we look at from a deal structure, right? There's just how do we deepen where we are operating, so how do we kind of expand into new markets completely, you know, how can we add new service offerings? When I look at this deepening, you know, the family business type thing where we're buying a company that's doing $20 or $30 million of revenue that could fit into our company, as I described earlier, there's probably 10,000 of those out there in the U.S. And so we have engaged an outside for, you know, like a business services firm that will, you know, that's cultivated those relationships over years. They know what we're looking for. You know, with their help, probably talked to 700 of them in the last, 6 months, which would be impossible if it was just me or my team doing. And also they're able to, eliminate or kind of, triage the ones that really fit or eliminate the ones that don't fit. And I think there's some benefit of having that third party conversation than it would be if I was representing, almost cold calling companies and saying, hey, do you want to sell to us? Kind of, that's not the message we want to put out there. So we like having that little bit of separation.
John, can I follow up real quick?
Sure.
Do you mind sharing with an acquisition search firm, how do you compensate them and any lessons learned of how you've managed them as a vendor effectively or any challenges you've run into with them?
Sure. So they get a percentage of the deal, a fee off of the total. They probably get overpaid, but...
That's what my board always say. Why do you pay me so much, right? Because I worked for 8 years, didn't bring one deal, and then they made one deal, and that's how they make their money, right?
Yeah. And so they're incented to get it done. We have a bunch of rules in place. They can't double dip. They can't be representing the seller as well. And so there's a lot of relationship around that. But we do, I think, pay them fairly if they're bringing us good stuff. What was the second half of the question?
Just any insights into how you've managed them to be more effective? How closely are they integrated into your strategic planning? Are you even testing ideas with customers or business unit?
Yeah, so there's different people go about it different ways. And when we started talking to these guys, they wanted to be, if you were to engage a bank as on a buy-side project, they would be trying to sell much more. We're going to run the diligence for you. We're going to do all of this stuff. We're basically turnkey solution, and we didn't want that at all. So our relationship and what we were looking for with people that can help us is, you find us a company, it matches the criteria. I'll do one joint call with them, and then you're out of the process, essentially. I've talked to them every day, but we don't want them involved in our diligence process. We don't want them sort of involved with anyone else. I don't think anyone in the company has met them except for me, which is just kind of the way it works for us, and it's worked out so far. We haven't had it go wrong yet, so I can't answer that part of the question because this project's about 6 months deep, but so far it's worked really well.
So in most environments, deals are competitive. There are others at the table that are looking at acquisition targets. How do you stay disciplined in the process? How do you, because as you go through, it can develop momentum and sometimes a life of its own as you go down the process. How do you put the brakes on or decide, this is not the right choice for us right now, or we need to ratchet back our price? How do you balance being competitive and winning the deal with still following your objectives from a financial and a strategic standpoint? And how do you self-regulate? Good question. And whoever wants to start can start.
Oh, you want me to start? Okay. So, I never knew, and maybe the two of you have a better idea, or three of you have a better idea. I never knew whether I should go in high and then walk the target down in order not to be thrown out in the first round at the auction, or to go in with a realistic price. But what I always try to do now as a board member with the companies I sit on the board on, and before, in the company where I was as CEO, I always try to come up with a walk-away price from the very beginning. Of course, you don't have all the information, and this number might be adjusted as you learn more into diligence, but probably not too much. So you need to have a walk-away price. You need to get really disciplined about it, because if you don't, you might get caught up in the heat of the moment. Give another example. We tried to buy a publicly traded company in the UK, and first we tried amicably, but they didn't want to be sold. And so we started buying, creating alliances with shareholders, and at the end we had more than 50% of the shareholders support our price. Said if you make an offer at this price, we're going to support you and you're going to vote for the deal, right? Unless somebody comes in with a 10% or higher price. Sure enough, the moment we floated our price and it became public, Tyco came in, and this was Tyco when Dennis Kozlowski was still the CEO. They would buy companies left and right? They came in, and we waited one day, and then we announced we are going to pull out because it was beyond our price. So we couldn't figure out how to make it accretive in year one. Tyco said they would make it accretive in the first quarter, right? So we just had to walk away. So you have to be disciplined.
Fully support the comment about a walk away, and that's an excellent discipline. And Frank, as you mentioned, it can change based upon learnings. I think in addition to that, though, how does one get to what is a robust walkaway price? I think it starts with culture and values. That one has an organization and a deal team that is inclusive and diverse and values a breadth of different points of view and opinions and provides for open, robust challenge, respectful challenging. I think, second, leadership matters. And so how leadership shows up and steers or cultivates or facilitates that conversation will make a very large difference.
I have a question. How sustainable is the market? I mean, we've been in a seller's market for maybe 2 years. We have record multiples, unprecedented capital out there. But my group does about 1,200 transactions a year. 60% of those are cross-border. The multiples that are getting paid, I just don't see a return on any of these investments. How sustainable is the market today?
It's funny, we debate this all the time, and we're talking about it a little bit last night. There was an auction we participated in recently where we put what we thought was kind of a walkaway price from the beginning. And the feedback from the banker was, not only are you low, you're materially last place.
And it behooves them to say that, though.
Right.
That's how they get paid, right?
And and also with some of these family businesses that I've alluded to before, I've had two people say in recent weeks, I'm like, why are you selling your business? And it's never going to get this good, and everyone's telling us to sell, which is kind of a hard thing to say to a buyer. But they're doing it. In our space, and I'd be interested to know what your markets, what you're seeing in your actual markets, but there's been a lot of sponsor activity, much more leverage, and I don't know how long that's going to continue to last, but if you look at roll-up strategies that are heavily levered, right now you're in a situation, probably for the last 3 years multiples have been elevated, but now you're on kind of a peak EBITDA run rate with an elevated multiple on top of that. And then so, a year from now, let's say you're paying 10 times for a business that we think is worth 6, still you pay 10 times for it. If we start to roll over a little bit and EBITDA is down 20% next year, then suddenly you're paying 16 times, for a business.
Yeah, but then these are all on pro forma adjusted numbers
Yeah.
too, which is frightening.
Unrealized synergies. That's my favorite one. Planned but unrealized synergies. And they're getting away with it right now. So, again, I look at kind of the deal flow in the logistics space. Like I said, the last 3 years, the multiples have been elevated. But actually, the most deals over the last 10 years was back in 2012 in our space, and the median multiple was 7 times. The last 3 years, it's been 10 to 11 times. So I think there's, and you had a big ramp up of private equity, kind of influx over that period, as well as just the market being hot. So, in 3 or 4 years, is there going to be an opportunity to buy these companies at, back at more reasonable levels? Like, I hope so, but I'm not sure. So anyway, we think about it a lot and hope it improves.
So Cargill is a cash buyer, and share your views in some respects in the sense of multiples being elevated. We buy and hope to hold and build forever, and so we underwrite to a case that is reasonable across that, and the laws of gravity apply. So an elevated multiple that's beyond what is reasonable value is just that. So we'll have to wait. I think what we find is that it's not monolithic, and we're doing lots of transactions in a variety of geographies around the world. So buying a somewhat distressed poultry business in Colombia is a different story and might trade at a very different kind of a multiple. It leads us, at the end of the day, I think this kind of a market leads us to focus on transactions that are the strongest strategic fit, for which we are a better parent or owner of that business by virtue of how we can help that business be successful, how it helps us be successful, and so we can feel more confident about that underwriting case and pay find value and be able to pay that. Otherwise, we're not going to do the deal.
Yeah, I cannot tell you if it's sustainable. I don't have a crystal ball, but it's not about making the deal. It's about creating value for your owners, shareholders, public shareholders, or private owners, right? And that's what it's all about. And if you look at a deal and you cannot justify it financially, you shouldn't do it. That's how I always looked at it. And sometimes the best deal is a deal you never did, right? So I think right now it takes a lot of discipline to walk away from deals. Sometimes I hear, I heard this sometimes, it drove me crazy when people would say, oh, it doesn't meet our financial criteria, but it's very strategic. You know what? Strategic to me is when it makes money, right? When it hits our financial criteria. So it has to be both. And of course, the question is the timeline, right? But if you're the best buyer and the best strategic fit, you can bring more to the party than anybody else. You can create more value, but it has to ultimately, within a predefined period of time, make money. Otherwise, you shouldn't be doing the deal.
Agreed.
So we've been talking about rising multiples and financial discipline, but I mean, we're here in the Bay Area, right? It's the tech hub, and we see lots of deals where, I mean, what's the multiple of 0? But yet they're still very high valuations being ascribed to companies that are developing technologies that we don't know whether there'll be a market for. I mean, you see the deals that are being developed to acquire technologies for autonomous cars. I've never driven in one. Maybe it'll make me vomit. Will anyone ever get in one? Who knows? But there is a market. There's an M&A market there. So what's going on in that space? And I open this up to the floor too. I mean, what with technologies that are on the cutting edge, what's going on? Is there just too much cash out there that needs to be deployed? Is it a defensive play? Is it really buying the people in the future? Any thoughts on the tech deals that we're seeing in these really developing areas that don't have validated markets? Maybe John, start any of your thoughts.
Sure. Yeah. So I mean, from our perspective, there are a lot of disruptors, as we would call them, as they would call themselves, that they're trying to come into our business and suddenly make everything simple. Uber is a good example of that. And And so it's something we think about and we talk about, and we have people come through quite often selling, the newest version of basically what we already do. And the challenge we've had with what you do with these people is there's a difference in being kind of on the innovation curve as versus being scalable, right? So if you were to look at a product that is, or a service that may be slightly better than, at least in optically than kind of the system we're using now, the amount of work we'd have to put into actually making it work on our system and actually scaling that thing up, basically, it kind of nullifies whatever the benefit of the deal was. So it's, ours is unique because all we are is people and technology. So we kind of think of ourselves as innovators, and we're building a lot of that stuff. And some people are like, hey, look, it took me $2 million in 3 months to build this thing. And that's just not going to work on our platform. So that's sort of the challenge we come up with. And look, the people who are coming up with a lot of these technologies and the companies that are being started out here, they're much smarter people than me. They're much smarter people than most of the people we employ. So I'm not saying they don't create value. It's just we've struggled to figure out how we incorporate that into what's already a pretty robust technology platform.
Peter, how do you think of these deals? I mean, is it?
Well, I can speak to what Cargill is doing with respect to emerging technology. And at the end of the day, I think Frank's comments about something has to ultimately generate profit with certainty matters. And so it's about measuring the bet relative to what the risk is. Cargill is active in a breadth of emerging technology investment. We've done half a dozen Series A, Series B investments over the last 6-9 months in artificial intelligence, machine learning, remote sensing, micronutrients, alternative vegetable protein, alternative meat protein. We got a large write-up about our investment in Memphis Meats, which makes cultured chicken, as an example. In a variety of biotech spaces. Our most recent investment, which got a write-up, was we made a small investment in a startup that does facial recognition of cows and pigs. So, but
that's breakfast marketing.
Do you
for
swipe
you.
left or swipe right?
yeah, right, exactly.
You're eating Wilbur. Here's his face.
Points on that one, I think. But none of those transactions, the equity investment is the full story, nor the more important part of the story. The more important part of most of the stories is the collaboration. It's the relationship, and the equity is what follows along, and it's a very small part of the total economics that we're looking to explore and create. The leverage on, for example, artificial intelligence combined with remote sensing for Cargill is significant across a breadth of our business models. And so the handful of millions of dollars that we've invested really pales in comparison to the value that we're creating in the collaboration between ourselves and the company.
Yeah, I mean, I struggle with way out there new ideas. Maybe because I grew up in industrial manufacturing, which is not, the high tech and, way out there thing. Maybe because I'm not smart enough, but I always struggle. So because of that, because I'm not this brilliant person who sees what could come out of this, we probably miss some opportunities by not getting in at the very early stage. But I think there's also an opportunity to get in a later stage. It's more pricey, but my philosophy was always the second mouse gets the cheese, right? It's sometimes not the company which is bleeding edge. Sometimes it's the one who comes in afterwards. You look at companies like Tesla, right? They're certainly innovator. Are they ultimately going to be the one who is going to make a ton of money, or is it some of the more established players? I don't know, right? And because I don't know, I would never go in at the very early stage, because I said I'm just not brilliant enough to see what others might see. On the other hand, I think it's a safer strategy. But on the other hand, you don't make as much money because you have to pay a higher price when the technology is more proven.
So fully agree, and just the example of, again, artificial intelligence, remote sensing, we've been out kissing frogs for about 8 years and meeting with many of the major players. And we've taken our time to come to a place where we could find somebody that we could collaborate with.
Peter, how much of your time do you invest in trying to really understand all these technologies and the new stuff that's coming to market versus being able to rely on the different business unit managers that may be looking at this, and you come in and do the pure deal diligence.
Just given the complexity of Cargill, it's not possible to dive deep in our rules. And so we partner with people in the businesses. So in the emerging technology space, there's a breadth of activity, but I would say there's probably half a dozen nodes with dedicated teams of people, business-based. We're very focused going deep in those particular spaces.
So this has been a nice transition into discussing other alternative means of developing not necessarily an acquisition strategy, but a partnering strategy or a corporate venture strategy. And so Peter, it sounds like Cargill takes an approach of looking at a portfolio range of different companies that may be of interest, either from a partnering or a future acquisition standpoint. If maybe you could just elaborate on how you view your corporate venture, joint venture strategy tying with the ultimate M&A strategy, the straight acquisition. Are they synced? Are they separate? How do you integrate the different opportunities to partner with these emerging companies, with your overall strategy?
Well, I would be honest to say we've wandered in the wilderness for quite some time, 30 years of experimentation. And we started with a corporate new business development team. We then created a corporate venture company or business. And it had a rise through the dot-com era, and then thereafter we rationalized it, quote unquote. We developed thereafter an emerging business accelerator, trying to identify both internal and external innovation ideas and to support them. We built a technology venture fund. We have asset management businesses, PE and hedge fund, and at High Point had about $16 billion of assets under management, and put some venture activities into that. We've cycled all throughout that, and we've come back to where we started, which is that emerging technology investment is part of the business. It has to be on strategy and owned by the business. And so we now support that across the company where it makes sense. Every transaction goes through the same corporate development process with respect to expert support around being able to consummate a transaction. We have corporately about 150 joint ventures and minority investments today. And the net change in that is probably about 10 a year. So we go down 5 or 8, we add another 15 to 20 or something like that. It is, as Frank said early in the conversation, it's a tool for building a business. It's not the only tool, and it has to be compared against the alternatives, whether it's organic or some combination or an acquisition. So it's just a tool.
Yeah. Any questions from the audience on this topic? So I want to switch a little bit on topic to doing the deal itself, and really 2 questions. First, any golden rules that you live by when you're engaged in doing the deal? And second, what will just kill a deal for you? And maybe John, start with you on this one.
Yeah, I mean, I think they're sort of hand in hand for us. Given that our scope is fairly narrow, we're very focused on people and technology and non-asset based, so there's not a lot of cost levers we can pull. So for us, it's all culture and fit and who's going to work well in our platform, and those are the people we want to bring in. So I think a golden rule type of a approach to that is find those people, right? And deal killers normally where deals fall apart. It's where when we would bring them in and meet our whole team and get to know these people, it just doesn't seem like they're going to fit for whatever reason. And then so essentially you're buying air, if the people aren't going to stay and they're not going to sell your technology. So those are kind of the biggest pieces we look at.
Yeah. How about you, Frank?
Yeah, I couldn't agree more. Culture is, to me, the most important thing which kills deals for us. I'm going to give you an example because most of you have not been in Chicago, so I can tell the story again. It's one of my favorite stories in culture. But as far as, well, I'm going to come back to the golden rule. So we tried to buy a company in China. It was right in the middle of what we do. And we really liked them. They were straightforward people. They were so straightforward, they told us about all the things which might be a problem for us. And I said, you know, we have a couple of books. We have the books for the financial authorities, where we don't make any money. You know, for the IRS, you know, the tax authority, we don't make any money. And then we have the books for the planning authorities, where we hit the plan. And then we have our real books, where we make money, right? And we just want you to know this. And then we have some customers, maybe representing 20% of sales of the company, and we bribe them that we get the business, right? And then we have dormitories, and they are co-ed, and sometimes we have knife fights there, jealousy things, right? And we said, well, we can fix all this. First of all, we're only going to have one book, and we're going to guard against any tax liabilities, first thing. Second, we're not going to bribe any of the customers because we cannot do this as a publicly traded US company. And we're just not going to give you credit for the sales and the profit generated from those customers, so we can reduce the purchase price. And thirdly, we're going to give all the employees more money, and they can go out on their own and have their own apartment, and we have taken care of this dormitory thing. But then we said, wait a minute, if that's how they run the company, you know, if that's how top management runs the company, they probably hire people who go along with these kind of practices, bribing customers, having different books and so forth. So we ultimately said, if we want to have a clean company, we probably have to let too many people go, and then we have what you said earlier, we bought an empty shell, right? And we have nothing. So we walked away from it. So culture to me is paramount. I could give you several other examples, but I'm not going to do this. As far as golden rule is concerned, I would always tell my team, don't screw it up.
That's a good one. I like that. Peter.
Frank, I'm glad you told that story so I didn't have to tell my exact same story. Yeah, culture matters. At the end of the day, we all make things happen through people, and winning hearts and minds is the way by which we do that. Employees, customers, other stakeholders. And so if there's something that's going to get in the way of that, and there can be a number of items, that's perhaps the greatest watch out.
Yeah. I mean, from the legal perspective, I'd certainly say honesty is really paramount in who you're dealing with. I mean, you don't want to be buying an SEC investigation. You know, you don't want to be buying, Attorney General, investigation. That's not part of your business plan.
You're absolutely right. You don't want to buy that. That said, sometimes transactions have these complications. So they have an SEC investigation. They have a Superfund site. You've got an FCPA issue. Digging into those, if there is a way to work through that with confidence, you can find a transaction that may not be accessible by others. Yeah. So I agree, those are things to watch out for, and indeed will kill a deal, but sometimes finding the way to work through it and still finding something that's of value can be a very interesting transaction. Yeah,
no, certainly, I think in those circumstances, how that target has dealt with the issue, shit happens, right? Things happen. How are they dealing with the investigation? Are they dealing it? Do they have they approached it in a manner that gives you confidence that you can make the certifications that you have to make as, if you're on a public company, or are your auditors going to be able to audit your financial statements in that way? So it's certainly not unbridgeable, but it's a tone that gets set from the top.
Just as a story on that, Cargill had been the second largest fertilizer company globally. Mosaic is our child or spinoff, but we started that business by buying what was effectively a bankrupt fertilizer company with all sorts of environmental problems and issues for the city of Tampa in Central Florida, and we took it on, and we came fully clean with respect to what the issues were. Some of them were not being disclosed, and we committed to working through it. It took us a couple of years, but it became the foundation of a very good business.
Mm-hmm. So looking past the deal and then into the post-closing integration. And I want to ask a couple questions we touched on. Peter, you touched on, and Frank as well, about culture and developing and integrating the culture. Sometimes, and I'm thinking again along the innovation cycle, sometimes you want that cultural shift. It's the shot in the arm that it's going to lift up maybe a division that is not performing or hasn't really been prodded along in the way that you would hope that they would. And so now having that sort of virtuous competition of a new cultural infusion might be helpful. But how do you get with the number of acquisitions and knowing that there's value in diversity? How do you foster that culture that you're buying so that you don't kill it, but you still integrate it so it's accretive to your business? Frank, any thoughts there?
I'm not sure I ever did it right, so I'm not sure I'm the best one to answer. I can just give you an example. We bought a company in one of our business units, right? And it was the number one competitor. They were larger than us. We were number two, they were number one. And I thought, because they're number one and they were more profitable than us, why don't we let them lead this combined business? So the top management position was by the acquired company. And I thought it was brilliant, right? Because how better to motivate them? We bought you, but you are in charge, and it's your culture and so forth. This went fine as long as everything was fine. And then all of a sudden we had some problems. And then the finger pointing started. All people said, what, it's never going to work, and so forth, back and forth. So then we went from a mixed culture. We kind of tried to mix their culture and our culture. This didn't work either. In the end, we ended up with our culture, right? So I think there's always this gravity towards your culture. And I was wondering, in your case, how do you do this? When you buy a company, you want to have shot in the arm, you want to have this maybe innovative spirit, entrepreneurial spirit, and you get in a company with over 150 years, you said, right, in business. How do you deal with this? I think I never got it right.
It's very hard. I'll share one example where I think that we very much valued the culture of the company that we acquired and wanted to create something that was new, a new third thing, if you will, a combination between the two businesses. This is in the animal nutrition space. We bought a company called Previmi, a leader in the premix space, who larger than Cargill in our premix business, but coming into a even larger overall animal nutrition group. And that group has just a tremendous ethic and set of best practices around being clear about culture and values and behaviors and process. And they have something called the Green Book, which is effectively their shared set of beliefs about who they are, how they operate. And one of the efforts that the overall group made was to sit down with Previmi's leadership and a broader set of their employees to say, let's just put it all on the table. What's your version of the Green Book? Now, let's jointly, through a period of months, put it together and create a new Green Book. Now, let's all stand behind it and take it out to every single employee. And that has been able to, I think, incorporate some, it's not perfect, of those key cultural elements that come from both sides, if you will, into something that's new. And now we're 6-7 years on, and I think it's all one, but it's taken that period of time. It's hard. It takes focus and concentration on all that matters that's about people.
John, yeah.
Yeah, I would just add, if I looked at, we've done, some larger deals, but you look at the smaller deals in particular, the change management piece and the operational diligence up front have proven themselves to be so valuable in terms of, where things have gone wrong. It's like we didn't understand their phone system, and there were only 15 people. It wasn't a big deal, but now they become part of our company, and they can't get email, and they lose 2 days of productivity, and everyone's pissed. And so trying to anticipate those types of things that don't really seem like a big deal, but in the end turn out to be, very big deals for the people whose livelihood is being disrupted through this process. So we try very hard. We have a project manager. We pull in different people from different business units. We have a phone tree of who to call if this goes wrong. We put a lot of people on the ground training and have touch points constantly post-deal, just to try to make that transition smoother.
William, what do we have, about 5 minutes left or so? 2 minutes. Oh, okay. All right. Well, got too excited, but maybe just one or two questions from the audience. Looks like.
With the ubiquity of financial sponsors being in some of these deals, is there an opportunity emerging for strategics for family-owned businesses to be a more attractive endpoint and they care about their legacy? Is that a differentiator for you guys?
We try to use the sponsor boogeyman to our advantage all the time, in the sense that, we're going to take care of your people. You're going to be part of a culture and a technology where everyone's going to grow. And if you go this way on the sponsor route, they're going to sell you in 3 years. You're going to have a different owner. So I don't know if that ends up being true or not, but it's what I try to sell.
All right. I think we have one last question over here.
Thank you. So I heard all of you mention culture is a big aspect when you guys are looking for acquisition. Walk me through examples of where you're looking for deals to buy, but the culture's not there, the targets aren't there, where you decide, time out, let's do it ourselves.
Yeah, I mean, I gave you an example, right? Not sure if we ultimately did it ourselves. We probably brought somebody else. Well, but we did a lot organically. I think you get into a mess if the culture doesn't fit, right? We would always walk away from deals. And I can give another example, really quick. A company in the US walked with their plant, and there was a barrel with solvent dripping in the ground, and the owner said, we said, you're going to fix this. He said, it evaporates before it hits the ground, right? This was just one example, right? And you kind of have other examples like this, right? And if you have a couple of things like this, you wonder, is this really the company you want to buy? We always walked away and either bought somebody else or did it organically.
I think it comes back to the breadth of exploration to really measure what's the opportunity from an acquisition or a joint venture. And an example of building a business for Cargill in China, there have been a number of significant acquisition targets and the possibility of either acquiring or joint venturing. And we've explored them in depth and just found the challenges to be so significant that the alternative of building it ourselves, which was going to be longer, more expensive, perhaps a bit more risk with respect to market share and winning customers, it was a better approach. And we decided that we would do it that way.
Good. All right. Well, thank you all. We've enjoyed this conversation.
All right.
Thanks, John.
Thank you.
Yeah.